Hello everyone, Michelle Brienza here. I hope that you're well. Big shifts are happening in both Canada and the US, and trust me, they're going to impact your mortgage and your financial future. So on the one side, we have the Bank of Canada that's quietly rethinking how it measures inflation. So Deputy Governor Rhys Mendes admitted that mortgage interest costs are distorting their inflation ratings. Poor babies. So now the Bank of Canada is considering removing mortgage interest from those measures, or even ditching it completely from its current inflation gauges altogether in favor of something called underlying inflation, which they describe less of a statistic and more of a feeling. That's right, a feeling. We're going to go with vibes. Why does this matter? Because how inflation is defined directly affects how high interest rates need to go. So if mortgage pain, which we're all feeling, is excluded from these readings, then the Bank of Canada can justify higher rates for longer, even while homeowners continue to struggle under huge renewal gaps over the next 12 months. Meanwhile, there's a partial shutdown in the US. And this slowdown is, there's a slowdown and it could halt operations. And that puts a lot of stresses on mortgage originations as well, especially those that are tied to government insured or guaranteed loans. So if deals get delays, closings stall, there's this whole ripple effect that starts to happen. And I don't know if the market can handle it. So the shutdown also causes gaps in data. Economic reports get delayed, and that means that policymakers, including the central banks, they can't see what's going on in real time. So when the data's fuzzy, markets get a little jittery, and that kind of volatility can feed into interest rates and mortgage pricing, and sometimes it goes in the direction of higher. So what does this all mean if your mortgage is coming up for renewal in the next 12 to 18 months? Well, number one, you might face higher rates for longer than you might have expected, even if inflation is officially coming down. Second, delays in the US housing finance can spill over into global capital markets, and that'll influence Canadian bond yields, and that'll influence mortgage pricing, as I've talked about. And the third is uncertainty and volatility, and it could push lenders to be a little bit more tightening with their credit and things like that, a little bit more cautious. So, it puts a bit of a squeeze on Canadian homeowners and their wallets for sure. And this policy isn't just like wonky stuff. These are real risks that, families are going to have to endure, especially if you're trying to plan a renewal or a sale or a purchase. This will all have an impact. And so keep your eyes open over the next little bit on these stories, because I'm not sure that mainstream media is going to be reporting on this sort of stuff. And so whether you continue to follow here or follow other people, just keep your eye on these things, because these are the things that impact your finances at the end of the day. So look, I tried to keep these as short as possible. If you've made it this far into the video, I so appreciate you. Thank you so much. If you want to like and subscribe, that would be awesome. If you want to share it with somebody who might want to hear this, that would be fantastic as well. And, but I also would love to hear a couple of comments. Like, what do you think about all of this? Where do you think that Canada is going? Do you have concerns? Are you convinced that rates are just going down and they're going to stay down for a while? I'm pretty sure they're going to go down, but I'm a little bit concerned about when they're going to go up, especially with no budget and stuff like that. Anyways, I'd love to engage a little bit more, either online or offline. Give me a call if you want a customized pre-approval consultation, or you need to discuss your renewal that's coming up. Until next week, be well.